Okay, so welcome everyone to the pre-retirement seminar for instructional staff. Today's topics are pertain to pensions, whether it's TRS, the TIAA optional retirement plan. Our first speaker is going to talk about estate planning. Our first presenter is going to talk about estate planning, and while the information is something that you can get from an attorney, I think that it's important to get a foundation in that subject matter, so that when you do go to an estate attorney, if you ever needed one, you know the questions to ask and you have a foundation of knowledge to begin with that I think is important. So our first speaker today, so after our first speaker, we're going to hear from Joe Neighbor from TIAA about estate planning. Then we're going to hear from Peter Quinn from the 457 plan. And the reason why I like to invite the 457 plan is because it gives you an opportunity to invest additional pre-tax earnings for planning for your retirement. Normally, the tax deferred annuities that are offered by TIAA and TRS have to be coordinated. So if you're in TRS and you have a TDA, but you also have a TDA with TIAA, those balances are coordinated. They have to stay within the IRS limits. But even if you're maxing out on your tax deferred annuity with TRS or TIAA, you can defer an additional pre-tax maximum in the 457 plan. And that's why I invite them. So even if you're a year or two away from retirement still, you have the opportunity to put away as much pre-tax earnings as you can in preparation for retirement. So that's why I think that's an important topic also to go over. And finally, our last session is going to be with TIAA and simultaneously with TRS. TRS participants will go into a breakout room and meet with Monique from TRS, and the remainder of the attendees who are in TIA can remain in this room and you don't have to go anywhere. So without further ado, let me introduce Joseph Neighbor, and welcome, Joseph.
Hey, thank you for having me, Talon. I hope everyone's having a great day. In my daughter's school district, it is a take your child to work day. So some of you may be having a more interesting day than your typical Thursday. And
there were so many kids on my train today.
Is that okay? That's great.
That's how I knew. That's how I knew it was take your kid to work day.
That's wonderful. Well, if you see a 7-year-old in the screen, that would be the explanation. I said, I need to get up and work now. She said, okay, I'll see you soon. And I thought, wait a minute, what does that mean? Without further ado, you're not here to see my daughter Grace. You are here to learn about basic estate planning considerations. So let me put up this deck. I apologize, I am not an expert when it comes to teams. Let me get this up. This is the one, and
we can see it.
Perfect. Thank you. Okay. So first of all, I work with TIAA. My name's Joseph Neighbor, and I'm a wealth planning strategist. Some of you, it sounds like, attended the Tuesday session, and you would have met my colleague, Colleen Carcone. Our group is based of estate and tax planning attorneys, and our role is assisting families to understand their current estate plans and also to provide estate and tax education. And we often set the ground, lay the groundwork, just as you were saying, Talon, so that our clients can understand what it is what they want to address in their own estate planning and their own priorities with their families, and then go implement those concerns, go work on them with an estate planning attorney. So today we're going to look at basic estate planning considerations so that when you do have that conversation, you'll already be a few steps ahead. This will include the key components of a comprehensive estate plan, such as documents that you would need for managing an estate, sometimes a trust, but also before we really get to the estate, late life planning concerns, such as incapacity and medical care, and the documents that you will need to work to work with those. So first, a disclosure. We are attorneys after all. This presentation has been prepared for you as an educational benefit. This information should not be relied upon you as tax or legal advice. Examples in this presentation are hypothetical or illustrative only. You should always consult with your own attorney and/or tax advisor before making changes to your individual investment, financial plan, or estate plan. The TIAA group of companies does not provide legal or tax advice. Okay, and with that out of the way, today we're going to cover first lifetime planning goals. As I said, planning for medical care, planning for incapacity. This is when you lose the ability to make your own decisions and you need somebody to step in on your behalf. Making gifts to others, both in life and in incapacity. Also, charitable giving. Now, for estate planning considerations, and these are the considerations for after you have passed, what documents do you need in place? And we're just going to go into the basics. It can get really complicated, but these are the ones that everybody should know about before working with an attorney. Asset ownership considerations. As I mentioned, some of our clients use a combination of wills and trusts. How should you divide up those assets? Beneficiary designations. This is a big part for many of our client families whose considerable wealth, is often in qualified retirement plans. And also estate tax planning. After all, we are in New York today, and estate tax planning is just a consideration for many more families than it would be in other jurisdictions. So first, is planning considerations for your lifetime. Now, incapacity, like I said, incapacity is when we lose the ability to make our own decisions, and we need somebody to step in on our behalf. This can happen to a gradual decline. It can happen in disability. It can also just, one may reach a point where one just wishes for, say, an adult child to really take over financial affairs for oneself. So let's think about this. First of all, who would you trust to manage your assets? Do you have preferences for how your assets would be managed? Do your loved ones know your plans? Very often the answer is no. This is information we most of us are very private people, and it is when a child is expected to step into the role, it is very important to consider whether you should share that information or at least let that adult child know, hey, do you know that I've named you as a power of attorney for my assets? Do your loved ones have the time or acumen to do this? Again, ability and just capacity, time is a big consideration. Who would actually be able to step into your shoes? What would happen to you, and where do you want to live? This is probably a key consideration for many. In-home care, if one reaches that point, an adult living facility with assisted care. These are things that you can let your family know, and you can express your preferences, even in a legal document, to memorialize it, in addition to a private conversation. So I mentioned power of attorney. Now, let's take these issues one at a time. So in incapacity, or as I said, just handing over your financial affairs, maybe in the case of gradual decline, you will need a few documents. Now, the power of attorney is to grant someone the power to control your assets, those assets that are in your name, your individual management accounts, changing or updating retirement accounts, updating portfolios of your investment accounts, and your personal items. The power of attorney grants an agent whom you name the power to manage those assets for you. Here we have durable power of attorney. That is a power of attorney that lasts into your incapacity, meaning when you have capacity, you name your agent in the future. And then even though you lose the legal ability to revoke that power, the power of attorney endures. Most times nowadays, your attorney will your legal attorney, your lawyer, will draft a document that handles both of these priorities. So what are some considerations here? First of all, managing qualified plans. Again, at CUNY, this is going to be a big source of your wealth, as well as IRAs you might have rolled over previous retirement plans. Authorizing the agent to sign tax returns on your behalf, even though you're incapacitated, you still will have tax returns. There still will be filings that need to be done. Your agent would take care of that, work with your accountant. Transfers into trusts, if you've created a trust, transferring ownership. Now, this can be the power of attorney can be effective immediately, which means that as soon as you sign it, your agent has that power. It can also become effective on your incapacity. So if you have concerns about somebody managing your affairs, even though you are clearly able to at the moment, then you can include a provision that the power of attorney becomes effective only once you become incapacitated, and then your agent takes over. So I mentioned trust planning. So with revocable trusts, this is where you put your assets into a trust vehicle during your lifetime. We often see this as a planning for death. It is also, in addition to that, it is a common practice of planning for life. This is where you, as the grantor, work with your attorney and create the trust agreement. Now, people use the word trust in different ways. You often hear, oh, so-and-so, she grew up with the trust. That's probably an irrevocable trust that somebody else put together and funded for that person. With a revocable trust, though, this is a very flexible instrument. This is an instrument that somebody creates in life. And from a tax standpoint, it's really just the same as the person himself or herself. The IRS doesn't consider it a separate vehicle, and one can put money or assets into the trust and take them out. The key, though, for lifetime planning is that if one does become incapacitated, then one can not only empower another person, a trustee of this trust, to manage the assets, but can also include very specific instructions as to when those trust assets are to be used, generally for the grantor, the person who created the trust, i.e. you, in incapacity. So it goes beyond just naming someone who can manage your financial affairs, but with the trust, the trustee who has control of the assets that you put into the trust can use them with your instructions. With your specific guidelines saying paying for a live-in facility, paying for comfort and care, making gifts to family out of the trust, also naming other lifetime beneficiaries, such as maybe your adult children or your grandchildren. This is really taking that power of attorney a step further. And like I said, with revocable trusts, it's not the trust instrument that we might hear about, which is really a large wealth transfer vehicle. This is really just an extension of yourself. And the best part is that the IRS in your lifetime doesn't see it as distinguishable from yourself. So any income earned in the trust is just income to you. It's not a significantly more complex planning vehicle than than a power of attorney. It's really a supplement to it. Additionally, we've talked about assets.
Joseph, before you
Yes.
go on, there's a couple questions. Do you want me to read them to you?
You said we have a couple?
Yeah.
Yes, we can go through them quickly. If we
Okay.
start getting a lot of questions, it may be better to hold them until the end, but we can
Yeah.
do a couple right now, sure.
Okay. So
And I will go back to the previous slide. I'm sorry.
no, it's okay.
Okay.
If you name a beneficiary, should you also consider a durable power of attorney? I mean, those are really two different things, right?
Yes, a durable power of attorney is really a cornerstone document. And furthermore, when we work with an attorney and say, I would like a will. I hear that I need a will. The attorney will ask, okay, so that will take care of your assets at death. What about life? Do you have a power of attorney already? Do you have an additional document that we will get to a healthcare proxy? And if we're just asking about a will, the answer is probably going to be no, I don't have those. What are those? And generally, the attorney will prepare the slate of lifetime and estate documents. So the power of attorney is really something that we kind of have to have, because the alternative, and just let your imagination go to a dark place, is we become incapacitated. We don't have a durable power of attorney. We haven't named an agent who is specified as controlling our assets in incapacity, but we are still alive. Somebody has to control them. That means that our family now needs to go petition the court to have a conservator appointed. And that is all well and good, except now you've included money, time, and trouble to accomplish what the durable power of attorney would have accomplished already. So I cannot recommend, I can't give legal advice, but just as a to all of my new friends today, I can't recommend enough that when we work with an attorney that we ask about a durable power of attorney, and the lawyer will probably mention it already.
Thank you. The second question is, what happens if you name someone an executor who doesn't want to be the executor? What happens after you pass away and that executor is not happy about being named?
That's
What
a
can they do?
That's a really good question. Let's get to the planning for death documents, where I go into the will, and I will in the executor bullet points. I will cover. I will be sure to cover that. And if for whatever reason I can't, I get distracted. Talon, will you remind me of this
Yeah.
question?
Yep, sure.
Okay, because that's a very good question, and one that we should, like I said, let your imagination go to dark places. We should be thinking about that. Not everything's going to work out the way that we want to the first time.
Okay. Thank you.
Okay, thank you. Um, and just since we went back to the revocable trust point, or the slide, one thing I wanted to highlight as well is that not only does the trust uh, can you include provisions for how the assets in the trust are to be controlled in your lifetime, including your incapacity, but also what assets are in the revocable trust. Well, during your lifetime, they're just the assets that you put into it. Things do not accidentally slip over into the revocable trust column out of your personal assets. And so it really gives you flexibility. Like I said, the IRS does not consider it to be a different vehicle. It's not like, you and Google, which are clearly very different legal entities. Your revocable trust is an extension of you. So you can put something into it, such as an artwork collection, and that's not considered a taxable transfer to go from you to your trust. And if later you decide to take it out, you can do that. And again, it's not a taxable transfer in your lifetime. So it really is a lot of flexibility. But when you become incapacitated, the assets that are in your trust, say an investment account that you've titled to the trust, the XYZ Revocable Living Trust, that is what your trustee will have to manage for you. Okay, now other documents for your lifetime. First is a living will. And here we have the person who can have access to your medical records under HIPAA. This is the Healthcare Privacy Act, which just is incredibly important. I'm sure you've seen this dozens of times when working with your healthcare professionals or working with your spouse and sharing information. With your living will, also often combined with a healthcare directive, you can specify how you want to be treated in your lifetime, what kinds of care are acceptable to you if you have religious concerns. as well as end of life and comfort. So often these documents are combined into a single one. And as with the durable power of attorney, when you do work with an attorney, this will probably be included. The attorney will ask if you have one, explain it, recommend why it's important, and then for a single fee, you'll get the whole span of documents. Now, a healthcare proxy, think of this as the power of attorney for instead of for your assets, for your body. Because somebody has to make decisions that you normally make yourself as to your care, when to seek it, what you authorize, what you don't. Um, you need to you would authorize an agent to also make those decisions for you. Now, just like with the durable power of attorney, I said, sure, if you forego this document, you become incapacitated, and then it turns out you really need somebody to be making decisions for your care. Your family can go to the court, petition the court, and seek an appointment of a guardian. And that would end up being effectively the same thing, but it does take time, money, and trouble. But the healthcare proxy is where you appoint the person you want to be your agent. And similar to the durable power of attorney, if for whatever reason the first person is unavailable, you can name the next one, name the next person to take over, or you can name joint healthcare proxies. I don't, it's really up to you and your family. Some people name all of their children at once to do this together. Some say, I actually had a healthy or a funny client say, I'm going to name this daughter because I know that she would pull the plug if that were the right decision. But I'm not going to name that daughter because the first thing she would do is to ask if she can pull the plug. Of course, he wasn't being serious, but your family, your friends, and the people who are best to make this decision. But this is where you, like I said, you designate the agent to make the decisions on your behalf. And also, of course, you authorize that person to have access to your healthcare records. Now, just as I said before, you don't want to surprise somebody, when you're incapacitated and that person eventually finds out that you have named it. Somebody goes into the apartment, finds the documents. It is much better just to say, hey, I would like to name you. And so give that person a chance to say yes, or I'm actually I'm moving across the country in 6 months. Maybe I'm not the best person, but when that person is named, make sure that person has copies, because that person will need them in order to show I am the right person to be making these decisions. Okay. Now, lifetime planning. Also, this includes gifting. Now, this can be gifting in different ways. First of all, let's talk about gifting to individuals. So sometimes we gift for a tax reason, but usually we gift for non-tax reasons. First one is just the human element of enjoying seeing your family and loved ones receive money that maybe they need to go to school, or to make a down payment, or will help on the down payment to a home or an apartment. Just the general financial support that someone might need early in life or through a hard time. And also, if you are naming somebody, potentially you have more assets or more complicated assets, you want to see how that person does handling money. And so even with a small gift, if you see that that person handles it responsibly, that might give you confidence that that beneficiary is a good person to manage something a little more sophisticated, or maybe be in charge of, I don't know, your finances, potentially as a durable power of attorney later on. Now, tax-oriented advantages. Again, we are in New York, and New York has its own estate tax regime. So lifetime gifting might be a way to reduce your taxable estate. if your household is ultimately going to be subject to estate taxes, maybe making lifetime gifts of something that you would want to stay in the family anyway, and then getting them out of your estate before you pass within a timely manner, maybe making a lifetime gift is the way to do it, so that that money does not also trigger an estate tax. Um, when we do that, then the current value of that gift is what is assessed for the value of giving. Now, federally, lifetime giving is something that we document unless there's an exception. Federally speaking, each person has $15 million of exemption. So generally in New York, you just file the federal gift tax return and note it. But many of us are not going to be subject to the federal estate tax. For married couples, you can combine it's $30 million. We'll go into detail there a little bit later. But in New York State, the exemption is much, much, much lower than it is federally and much less flexible. So maybe giving an asset, maybe you have a house upstate or in a cooler climate for the summer, the value of the gift at the time you give it is when it is tallied, and maybe that's less than it will be later. And though, so it is advantageous to make the gift now instead of another time, or a stock that you believe might appreciate. And again, making lifetime gifts. If you have an asset that is generating income and you right now are in a very high tax bracket, maybe shift it to someone who's in a lower tax bracket who wouldn't be as adversely affected from an income tax standpoint and would also stand to benefit from receiving that asset. Now, making gifts to others, I mentioned the parallel regimes of the the federal income tax, or federal estate tax, as well as this New York State estate tax. If you live across the river in New Jersey, then there is no estate tax for now. But in New York, there definitely is one. But that's really to get to the point that you're working with multiple jurisdictions in the case of gifting and estate tax. The federal regime, which is really the most important, has the largest tax ultimately on transfers, gifts, and estates. Allows anyone to give on an unlimited basis to a U.S. citizen spouse. This is the unlimited marital deduction. We don't have to worry about that in life as in death. Um, all of that giving does not need to be documented. Same as giving to a qualified charitable organization. We can give on an unlimited basis, don't have to do anything. Just as a placeholder, though, or as a footnote, non-U.S. citizen spouses do have an annual limit as to how much they can receive. We can also pay on an unlimited basis for someone else's tuition and medical expenses. The caveat here is that that must be paid directly to the provider. So if you want to pay for, say, your grandchild's college tuition or school tuition, you can pay directly to the institution, and there's no tax owed by you on that, no tax owed on by the beneficiary, and you don't even need to file a gift tax return. It's very easy, but if you write a check to your child, and then the child is expected to write a check for the same amount to that institution, that is a gift. So to take advantage of this, you need to send the money directly to the institution for tuition that is providing the education. It can't pass through a loved one or a loved one's checking account. Additionally, we can gift $19,000 from me to any person in the world. And that is free of any gift tax, and we don't even need to file a gift tax return, which would lower our ultimate exemption that we can give at death. Like I said, we all have $15 million that we can give at death. that is also a lifetime figure. And as we make very large gifts, we don't owe any tax on it. The recipient doesn't, but it does reduce how much we can give at life or give in our death at our death. So if we say make a $1 million gift, if I make $1 million gift today to someone who is not my spouse and it's not exempted under some other rule, all I do is file a gift tax return, and the federal government, the IRS, sees it, and they just reduce whatever I can give at my death by that amount. So, it just instead of, if I died later this year after making a $1 million gift, that's not excluded in some way. My $15 million exemption in 2026 is just reduced to $14 million. And if I die with less than that, which currently I would, then no tax is owed. It's very straightforward. It's just think of it as an IOU against your exemption if you make a gift that is over and above these numbers. And again, that's 19,000 from me to any person in the world. Often spouses will split the gift, each use their own exclusion. So that means parents can to combine to make a $38,000 gift to any child, also to any grandchild, and as much as they can or want to give in any in a particular year. That $19,000 number, that individual annual exclusion amount, that does tend to rise with inflation. It was 18,000 a couple of years ago. It will probably rise next year or at least in the year after that. And like I said, that $19,000 is an exclusion, but just because you go over that doesn't mean that suddenly a tax is owed. You just file a gift tax return on the amount that goes over that, and that just goes to the IRS and reduces your ultimate taxable exemption at death. Just as a note too, in New York, there is no lifetime gift tax. They only look at your estate. But if you make a gift over this exclusion, and they use the same exclusion of $19,000, and you die within 3 years, then they look back and then they consider that amount. Okay, the best property to give. I mentioned property that's likely to appreciate. Property is likely to appreciate because the value, the size, or the size of the gift is determined at the time that you give it. Property of the low gift tax value and high estate tax value, life insurance potentially, because if we were to make a gift of a life insurance that has a present value, usually it's not worth nearly as much as it will be at death. And so the death benefit is usually much higher. So we would want to consider whether that makes sense. That just kind of depends on your family situation. As also income producing property. If you have a beneficiary who's in a lower tax bracket, that may be something good to give because it not only lowers your income tax, but it also may shift it to someone who doesn't pay much income tax at all. So if you're in a high bracket now, that may be something to consider. And I'm thinking again, like rental properties might be something that falls into that bucket. Now, charitable giving. This is something that we see a lot of our families in New York taking advantage of. So there are taxable benefits, of course, but there are also non-taxable benefits. So first of all, you have philanthropic objectives. You have organizations that you like to support. You believe in the mission. You can continue supporting them. It also can lower your income tax for the year. And it can also lower your potential estate tax. We see this a lot in New York, where the estate tax is going to either take a big bite or not very big bite at all. And sometimes a charitable gift can make the difference there. So very often in our New York wills and trusts, I will see a clause that says if a charitable gift will lower the ultimate tax bill owed by my estate, then I empower my executor or trustee to make it. That is, I never see that in any other states. I see it in New York all the time. So charitable gifts, what can you do? So depending on your age, cash may make sense, giving appreciated securities, or potentially other assets. We'll go into some of these, like the qualified charitable distribution, with which I'm sure many of you are familiar. One option is creating a donor advised fund. This is something that we have at TIAA. And this is where you make a gift now, either usually for tax reasons that you want to make the gift all at once to get the biggest impact, but you aren't quite sure where you want the gift to go just yet. You aren't sure which operating charitable organizations you would want to receive it at this time. A donor advised fund lets you make a charitable gift now to the fullest extent. You get the charitable deduction this year, but then later you and your family can decide how you want to make those gifts on a go forward basis. Think of it as a private foundation without any of the legal exposure or administrative burdens. You just let somebody else shoulder that. All you do is you decide where you want this support to go. Charitable lead trusts and charitable remainder trusts. This is maybe a topic for a different time, but there are complex vehicles where we can make a gift in life or death to a charity, where the trust pays income either to the charity first or to us or a loved one first, and then the remainder goes somewhere else. The charitable remainder trust is very often what I see in this case when we have a lot of appreciated stock and a need for income, but we also want to support a charity at death. Like I said, that is maybe a little more complicated, but just know there are vehicles to combine wealth and tax planning with charitable support. And finally, creation of a private foundation. In the reverse of the donor advised fund, this is where you would create basically a mini operating charity or a mini charity yourself that makes further gifts to other charitable organizations. This does come with pretty considerable administrative burden, though, and is maybe it's not a 101, charitable giving 101 subject. So we'll leave that for another time. So income tax deductions for charitable gifts. Something new this year. If you take the standard deduction, if you don't itemize your taxes, then you can still, well, now take advantage of charitable giving to reduce your income. This is something that is relatively new, signed into law last year. But if you take the standard deduction, you can still deduct $1,000 as a single filer, and as a married jointly filers, you can deduct $2,000 for cash gifts that you make to public operating charities. So let's say, the American Cancer Society, you give $2,000 as a married couple. You can still take the standard deduction, not go through the trouble of itemizing, and still get a $2,000 deduction this year. Just a note, it has to be cash gifts. You can't give a gift of $2,000 of Microsoft stock, and it has to go to an operating charity. You can't fund a donor advised fund with it. It has to go to the American Red Cross or into an operation that is doing the work, not just holding the money to make further gifts. We do not have time to go into all of this, but suffice it to say that when you make a gift of cash for itemizers, a gift of cash can offset a significant portion of your adjusted gross income for the year, up to 60%. Now, this is for a public charity. These are the charities that do the work. Like I said, if you make a gift to, say, a private foundation, the amount that you can offset goes from 60%, we go all the way to the right here, to a non-operating foundation. Then the fair market value of that cash, which is the amount that it is, can offset only up to 30% of your income for the year. If you can't take all of the gift this year to offset your income, you can carry it forward up to 5 years. Marketable securities. I'm just going to focus here on long term. Sometimes we make a gift, but we have stock, and that stock, if we sell it, is going to trigger really big capital gains taxes. one thing you can do is just give the stock directly to the operating charity. You can also do this with a donor advised fund. You can do this with a private foundation. But if you just give the stock, then you don't realize the income. But for a charitable deduction, you can claim the full value of that stock. So it's really win-win. You don't realize that taxable income yourself, and the charity gets the full value. They don't pay taxes, and you get to write off the full value of that gift on the as an itemized deduction. Now, one thing to note, there is a 0.5% floor for taxpayers this year on all itemized deductions. Okay. And so when you make a charitable gift, the first 0.5% is not going to be able to be used to offset your adjusted gross income. You put in the full amount, but just a tick below is what would actually come off of your income. That is new from last year. And if you are in the 37, if you have income in the very top income bracket of 37%, that is also limited this year. The way it works out is as of the 2025 tax law that was signed, the top income tax bracket can only offset up to 35% effectively of income. So the you can't offset all of your topmost income anymore. Now, qualified charitable distributions, we'll go into this a little bit more, but just the key numbers here. If you are over 70 and a half, you have the option of directing up to this year, $111,000 from your IRA directly to an operating charity. That number, $111,000, ticks up a little bit each year. But this is something that a lot of our families take advantage of, especially when they begin having required minimum distributions. They can use some of this qualified charitable distribution to reduce however much they would need to pay. So, for example, we had a taxpayer this year who had a required minimum distribution of $211,000. Then she could send $111,000 to a charity of her choice, and she doesn't realize that income, and all of it goes to the charity. And then she would have the remainder of her required distribution would be 100. She would need to take that. She would still pay the taxes on that, but she would not have the taxable burden of the whole $211,000. And it is generally better to make the gift directly where we can, instead of realizing all of the income, making the gift and trying to recoup the taxes that we've already paid. If you don't realize the income yourself, but you're going to make the gift anyway, it's often better just to make it directly to the charity. And qualified charitable distributions are one way to do that from retirement assets. As I said, it must come from an IRA and has to go to the operating charity. So just as a quick recap, your age and what kind of gifts make the most sense for charitable giving. When you are below 70 and a half, you really have marketable securities or cash, or you can make gifts of other things. I've seen some people make gifts of real estate to a charity. Once you reach 70 and a half, you can still make those gifts, but you can also make a gift of up to $111,000 of IRA assets in the form of a qualified charitable distribution. And one note here that really comes into play once you have required minimum distributions of your own. And then that qualified charitable distribution can lower your taxable income. If you were going to make a gift already, make it from your IRA assets. And then at death, retirement assets, especially pre-tax retirement assets. I have worked with families who leave a certain amount to their loved ones and make a certain gift to charitable entities. If you are going to split, consider making a gift of the pre-tax retirement assets to charities first, and then making a gift of your other assets to loved ones. Because again, retirement assets pre-tax, there's always going to be a tax owed on those, even after they go through your estate. The charity doesn't pay taxes, your loved ones will. The other assets that you have in your possession, such as real estate or investment vehicles, those are treated more favorably from a tax standpoint. Your loved ones do pay tax, charities don't. Retirement assets are generally the better ones to send to the charities. Now, estate planning considerations at death. We've already touched on those with respect to making charitable gifts. Now, let's look at some planning documents and other considerations. So, before working with your attorney, let's think about this. First of all, who would you want to inherit your assets? Are you concerned with beneficiary spending habits? I hear this all the time. How do you want beneficiaries to receive assets? Do you want them to get it directly, or do you want them to be restricted in some way? That's really the key question. When do you want beneficiaries to inherit your assets? Are they restricted for a certain period of time or indefinitely? How important is tax minimization to you in New York? Like I said, this is a paramount concern for many of our families. Who is going to administer your plan? Talon, we talked about that. That's a good placeholder when we talk about wills. But who and who after that person? And then do you have a catch-all executor? And can your beneficiary responsibly manage an inheritance? That a lot of that has to do with age. With some beneficiaries, as we know, age does not tend to improve that. So how does property pass? So you've got three key buckets. First, is those things that you own in your individual name or something that is that you are entitled to, that you do not have in a separate vehicle. Think of your car, think of your apartment, if you bought it and it's in your name. These are things that pass through your will. Your will handles all of those assets that just are yours and would need to be handled by through the probate process. This is where the court takes all of the assets that are yours and, kind of like bankruptcy, make sure that all of the assets are counted, make sure that any creditors with a legal claim are satisfied, and make sure they know who all the beneficiaries are. And when you have a will, they probate it, meaning they test it, they run it through and make sure that it's valid, was validly executed. That's the last will that you had. And also make sure that they are dealing with the correct personal representative. That is the person you name as your executor. Now, if you don't have a will, then the court will impose its own laws as to how your assets get divided, and they will name a personal representative who steps forward and is able to take on the work. Now, other assets, joint tenancy with right of survivorship. Many of you have investment accounts. Not that I've seen them, but just many of our accounts, many of our clients have accounts named as joint tenancy with right of survivorship. That means that the survivor gets everything. Just, if two people own it, first person dies, survivor just gets everything, does not go through court, does not go through probate, does not go through a will, just happens as a matter of law. Same with tenancy by the entirety. This is often how married couples own real estate, or transfer payable on death. Those are the codes on investment and checking accounts, TOD and POD. Again, they don't go through will, they don't go through court, just happens because that is the designation you put on the account. And last, these are beneficiary designated assets, such as your retirement accounts, life insurance, and then trust. If you put something in trust, you name beneficiaries. Regardless of what's in your will, these designations, the people you name for your retirement accounts, they get the assets because you named them and the percentage. Same with the life insurance. It has nothing. You could give everything in your will to Krusty the Clown, but your beneficiary designations and your retirement accounts will override that because that you specifically name who you want to get those retirement accounts. For many of us, this is how the majority of our wealth transfer happens. And again, beneficiary designations, those override everything. When you work with an attorney, be sure to bring your beneficiary designations with you when you want to talk about your overall estate plan, because very often those things can work at cross purposes unless you plan accordingly. Now, documents everyone should consider. We already talked about the lifetime documents, power of attorney, healthcare proxy, and a living will slash healthcare directive. Now, the last will and testament. So this distributes the assets upon death that you own in life and that are in your name. Again, these are the things like your checking account, investment accounts that you own that aren't titled in some other way, that aren't titled to a trust, or that aren't titled in a joint tenancy with right of survivorship. If it is just, me, the Joseph Nienaber investment account with TIAA, that would pass through my will. Also, just the things that we own that we don't think about, like if I own an expansive art collection, and I hadn't moved it to a trust, well, that would be probated through and would move by my will. Now, it names a personal representative or executor for purposes of the will. These are functionally the same thing. This is the person who will represent you on behalf of the court and say, I have the will. This is the actual will that Joseph Nienaber put together. And these are the beneficiaries. I am collecting the assets. The personal representative can always hire an attorney to help. And very often this is recommended. That money comes from the estate and has to be approved by the court before it can be paid. So no attorney can, really take you for a ride. The fees must be reasonable, but very often the executor just permits the attorney to do most of the heavy lifting. We always recommend naming a succession of executors so that if the first executor is just not up to the task or has moved or has died in a lot of cases, then there is another in place, and usually a couple of successors, just because we don't want to run out of them. Now, if we do, if there is no executor, the family, the estate can always go to the court and petition to have a new one appointed. One option is naming an executor of last resort, a corporate executor. TIAA does offer this service. Other institutions do as well. Again, just think of it as the executor of last resort, or just make it very easy for your family to get together and name a new one. But you always want to have a backup plan. Now, you can always name a guardian for young children. Obviously, with young children, you'd want to do that. And estate tax planning provisions, meaning moving money around, maybe creating trusts at death if that is favorable in New York, or moving money to charity if it will lower the total taxable bill for the estate. And just as a reminder, if you don't have a will, the state law will take over, and New York's own provisions will control where your money goes and how it's divided among your heirs. The revocable trust, we talked about this for a lifetime planning vehicle. At death, your revocable trust is now irrevocable because you're dead. You can't revoke it, clearly. But the nice thing is that in life, there was no distinction between you and your trust from a taxable standpoint. Now there is. So your trust can create ongoing trusts for your loved ones that will be distinct. The money in the trust will be a part of your overall estate from a taxable standpoint, but then it can do its own thing. It can go separate ways from the will. It can create new trusts. It can make outright gifts. Like I said, it is its own entity at that point, and it is irrevocable. No one can revoke it at that point. It also avoids probate. The judge overseeing the court of the probate process is looking at your will and enforceable debts. And from a tax standpoint, the IRS will consider everything that was yours, including your retirement accounts, including your trust, in addition to what's in your will. But what's in your revocable trust, those transfers don't need to be blessed by a court of probate, and that can significantly speed up the estate process in the probate court. So if you move your biggest assets into a revocable trust, that can actually speed up the whole process for your family. Like I said, coordinating ownership. I mentioned this with your retirement accounts in your will. Also make sure that you coordinate that with those with your revocable trust. Now, select a beneficiary of retirement accounts. So this was the third column from an estate planning standpoint. This can get rather complicated, but the key is this. To name a spouse as the beneficiary of your retirement assets, your spouse will have the ability to roll over your retirement assets into his or her own. And that will be then your spouse will be treated as having been the owner from the get-go, will not be treated as a beneficiary, but will be treated as the owner. That is the maximum flexibility. uh, to leave to an individual, then that individual who is not your spouse, that individual will be treated as a beneficiary of an inherited IRA and will may be subject to the 10-year time limit and may be subject to required distributions before that 10-year period has elapsed. Um, Additionally, if you name a trust, is the trust properly drafted to receive retirement assets? The rules for inherited IRAs changed drastically 6 years ago, and trusts that are older than that may not account for the changed rules, i.e., that most inherited IRAs who are not for spouses only last for 10 years. Um, and that can create a significant tax bill either for the trust that you've created or for your beneficiaries. And also naming an estate. Generally, this is not something that we see done, but it may be required or may be a good idea. Talk with your attorney when you need liquidity to pay taxes. Also, making gifts to charities. If you're going to split gifts between charities and loved ones, then pre-tax retirement assets are generally advisable for making charitable gifts. Now, should tax planning be part of your estate plan? I mean, the answer is yes. It should always be a part of your estate plan. But let's look at this map. So not all of us live in New York, but I imagine most of us do. New York has an estate tax. New York's estate tax is very different from the federal estate tax. I'm just going to give you the highlights here that the federal estate tax, like I said, is $15 million per person, includes lifetime gifts that aren't excluded in some way. And spouses can combine theirs for $30 million of exemption this year. That number will also go up in coming years from 30 combined. New York has a much smaller tax exemption. It's $7,350,000 per person, and spouses cannot combine it. So very often what we see is that two spouses of still pretty good wealth, but not someone that we would think of as, oh, that's a wealthy couple. Um, they in New York together, they will have, say, $7 or $8 million, leave everything to the surviving spouse through the unlimited marital deduction, and that surviving spouse will have $7 to $8 million. The thing that I want you to keep in mind, though, is that federally, there's no tax problem there. No 40% estate tax would be applied when the second spouse dies. But in New York, when spouses combine their wealth, the first spouse had an exemption of this year, $7,350,000, that if it went unused cannot be claimed by the surviving spouse. That exemption from estate tax in New York just disappears. So what you have then is two people's wealth and one exemption. And that subjects a lot more estates to New York estate tax than you would think. Additionally, New York State has the estate tax cliff, which means that New York only begins taxing estates at $7,350,000. At a very moderate rate, the estate tax starts at just a hair over 3% and then goes up very gradually to a top of 16%. But once estates reach a certain figure, and it's codified in law as 105% of the estate tax exclusion, so a little over 7,700,000, just 5% more than that exclusion of 7,350,000. Just know that New York State will then, at 105% of that exclusion amount, drop any exclusion at all. Once the estate reaches 105% of the exclusion number, New York drops the exclusion and taxes the entire estate down to the very first dollar. And so that is really the key for families planning around New York State is that many families go from owing no estate tax with the right planning to sometimes $1 million of estate tax. If their joint account is $10 million, with the right planning, they would use both their exemptions. Both spouses would use their New York State exemptions and owe nothing. But with bad planning on the second spouse's passing, that second spouse could owe that the second spouse's estate could owe up to $1 million on a $10 million combined estate. And this is something to keep in mind. I'm not saying everybody needs to move to New Jersey. It's a great place, but in New York State, careful planning is required. Because this is it's called New York State Cliff. You could think of it as New York State estate trap. It just traps a lot of families that wouldn't otherwise not owe any money with the right planning. So with that, I can't give legal advice, but I can advise you to lay out your plans to consider who you would name to take care of you in life, and who you would consider who you would think best to take care of your affairs at death. Most spouses name one another, but when we reach adult children, they are of different capabilities, different desires to serve, and sometimes are geographically mobile. So it's good to name a succession of agents, both for our lifetime and our estate planning purposes. Also, remember you've got your individual assets. You've got your assets that you might own with somebody that that person will get just as a matter of law, and then your retirement assets. These are three different buckets. When you work with an attorney, you want to know what your assets are, how much they are, and importantly, how they are treated. Will they be covered by a will, by a trust, beneficiary designations, or just by virtue of how you titled the account? And also charitable inclinations. Keep in mind the tax implications of charitable giving in life and death. It could be that making a gift, especially from your estate, if your estate is getting close to that estate tax cliff, sometimes a gift of a few $100,000 can save hundreds of thousands of dollars for your estate. Your attorney will tell you about this. It's sometimes called the Santa Clause, where your estate is generous because it actually ends up saving money. But it's good. Charity gets some money, and your heirs end up receiving more than they would have otherwise. So with that, I believe, Talon, this presentation is available because we've presented it. Is that correct?
If you email it to me, I can share it with everybody. But in the
Oh,
meantime,
perfect.
I wanted to get to a few questions really quickly.
Absolutely.
There's a question about, is a living will a full legal document? Do your wishes legally have to be executed?
Um, I have seen both sides of that. Whether they are enforceable, I mean, your medical care directives are generally are baked into the healthcare proxy, and so they are to be followed to the extent that that person named has the power. And so, the terms I generally see are I reject life-saving care. In the case of a terminable and incurable disease diagnosis. So the powers that the person receives are contingent upon following that document. Now, end of life care, or I'm sorry, not end of life, but like burial, that I'm not sure is enforceable. But that also goes to trusting the person that we name and spelling it out. But in terms of healthcare, I don't want a blood transfusion. That is often in the same document that gives the agent the power, and to violate that would remove that power.
Okay, thank you. Can you define lifetime gift? That was early on, so.
A lifetime. Okay, so just making a gift now instead of at death. And that can be
Oh, during a
really, yeah,
lifetime. Okay,
yeah, yeah, yeah.
okay,
I mean, we give at life or we give at death. And so
okay,
lifetime gift is, generally we're thinking about giving to our family to support them today, or to get rid of a high value asset that's even going to be higher value in the future, but doing it now instead of at death.
okay. If I leave my co-op to a friend who's also executor of my will, does this incur federal or state tax?
Yes. I mean, it still so if it goes through the estate, yes. Yes. I mean, it always it is all what does it incur it is a different question. Is it calculated as part of the estate tax and whether estate tax is owed? Yes.
Okay.
Yes. It always is. It's yes. Yes. I mean, everything you have in your individual name that you did not gift previously. So Talon, if I gave you my $1 million co-op today, and then 10 years later I died, that $1 million co-op is not part of my taxable estate because I gave it. That money, like that bird has flown. It is gone, and the IRS has that gift documented. So whatever my exemption is in the year 2036, it will just be my exemption is reduced by $1 million, and then so long as my estate isn't higher than whatever exemption is left, then I don't owe anything. But everything I have then would be calculated. But when you make a lifetime gift, it is gone. When you make a gift at death, they take everything that you have, whether it's going from retirement accounts, whether it's going through your revocable living trust, whether it's going through whether it's going through your will, everything goes into it. Even whether it goes through probate or not, it's all added up. And I just saw a question come through. What's the look back period for trusts? So if we make a lifetime gift, like I said, federally, they want to know everything if it's not excluded. You know, that's $19,000 per person to any person, and an exception for paying for tuition directly or medical expenses directly. And if we make a lifetime gift into a trust, so I create Talon, I'm sorry, you're the only person I kind of am seeing. So, but
Is that okay?
I make a gift trust for the benefit of Talon, uh, because I'm just that nice, and I make a gift of $1 million today into that trust. Then again, the federal government says, "Wow, you just made a gift of $1 million into a gift trust. That means it's an irrevocable gift. Even if I change my mind, Talon and I are not friends. I can't take that money back. It's like that is an irrevocable trust. Once you make a gift into an irrevocable trust, you can't take it. You can't take it out again." Or the value of it, it's gone. And so the look back period, federally, there is none because they never forget. Now, New York State does have a look back of 3 years. So I make the gift today for $1 million to Talon, and then die next year. New York State is going to look at all of my assets, and they're going to add $1 million to the final number because I made a gift within 3 years of my death. And it's not because New York State is mean. I mean, just let's be smart. If I had a terminal disease and I realize, oh, I'm going to have a huge estate tax bill, then I would just start giving things to my heirs. And that's what the 3 year look back is. Now, it's not a clawback. New York State wouldn't take the money out of the gift trust that I created for Talon, but they would just take the number of what I gave at the time and add it to the estate. Now, Medicaid is different. Medicaid might claw back because if I, trying to avoid paying for nursing home care and gave all my assets away, the state is smarter than that. They're going to say, no, we're not going to put taxpayers on the hook just because you didn't want to pay for nursing home care. We're actually going to unwind these gifts that you made to your family just before you realized that you needed it. So again, with the New York State, it does not have a gift tax. It has only an estate tax, but a 3 year look back, not a clawback, but they look and consider the value of the gifts, and add that back to your estate when calculating if your state owes something.
Okay. I'm gonna have to move on because we've gone over considerably and Peter is waiting in the wings. So I thank you very much. I'm not sure if you're able to stay on and maybe answer some of the questions in the chat, or, if you're able to do that, that would be great. Otherwise, I can send them to you and you can answer them and I can give them, respond
If you
back to
wouldn't,
whoever
I
asked.
apologize. I have an in-person meeting
That's
here coming
fine.
up soon. If you
Okay.
wouldn't mind emailing me,
Yeah,
and
I
then
will.
putting them together, and I can put them together or get a response to you
Okay,
succinctly.
good. We'll do
All right.
like
Hey, thank you
an
so much,
FAQ.
Talon.
Thank
All
you
right.
so much,
Everybody have a
Joseph. I
great day.
appreciate your time and insights. Thank you.
Bye. Thank you. Bye.
Bye. So our next presenter is Peter Quinn. I know I saw you log in, Peter. How are you today?
Good. How you doing?
Great.
Some great information there.
I've made you presenter, so you can go ahead and share your screen and begin your presentation.
Great. Thank you. Um, Appreciate everybody joining us today for the presentation on deferred compensation. My name again is Peter Quinn. I'm an account rep for the deferred compensation plan, and my territory is Metro New York. I cover Manhattan and Staten Island, but we have reps all around the state from Buffalo, Rochester, Albany, out to Montauk Point. So there's a deferred comp rep in your territory. Feel free to reach out to them. And I'd like to thank Talon for coordinating this. A lot of people think of retirement plans as kind of a set it and forget it item. They'll, look at it once, set up their contribution, and then kind of forget about it. And this is something that really needs to be looked at on a regular basis. And, meetings like this that towns put together, really help you look at this on, once a year, twice a year, that type of thing. So thank you, Talon. I'm going to go off camera just because it's distracting to me and share my screen. And make it a
We
full
could see
screen.
it.
Great. So today's presentation is called Countdown to Retirement, and it's reviews a lot of the things that you should be thinking about as you prepare for retirement. And when I say prepare for retirement, it's not just for the person who has 5, 10 years, or even 1 year to go. Even as you're starting out, these are things that you should be thinking about. And it breaks it down into 4 simple steps. Determining how much you're going to need. So looking at what your expenses are on a monthly basis, yearly basis, and where's your retirement income going to come from? And if there's any shortfall, how are you what's your plan to close that gap? We'll also look at protecting your retirement risks. We'll go into that into detail. There's a few of those. And then develop a plan and just keep it simple. So part of your retirement income should be the deferred comp plan, the 457 plan. 457 is just an IRS code section similar to 401k or 403b. It just spells out the rules of the plan. But basically, it allows you to contribute to the plan on through your payroll on a per pay period basis. Like a 401k, like a 403b plan, you could do either pre-tax contributions or after-tax Roth. And I'm just going to do a quick example and just use a round number to keep the math simple. If you're making $100,000 and you're going to put away $10,000 over the year or $10,000 and you do it on a pre-tax basis, you're not paying tax on 100, you're paying tax on 90. So you're saving money on taxes. The contribution is going in is deductible. The money grows tax deferred. And what I mean by that is wherever the money's invested, you're not paying any tax on the growth. But then when you pull the money out at retirement, that's when the government gets their money, whether you pull it out in a lump sum or you're pulling it out monthly or, once a year, whatever the distribution is, typically has a 20% withholding. The Roth works almost opposite. You're contributing on an after-tax basis. So if you're making 100 grand and you're putting away 10% or $10,000, you're still taxed on the full 100. You don't get the deduction. The money grows tax deferred. Again, any growth on the money, you're not paying any taxes on. And when you pull the money out at retirement, then it's tax free. So a lot of, financial experts say, hey, if your company offers a Roth, you should really consider participating in that. I think that's even, you know, more important for people who are getting a pension. If you're getting a pension from the state, that money's taxable. If you get Social Security, that money's taxable. Why not create this bucket of money at retirement that's going to be tax-free? And with any type of plan, it's not all or nothing. You could do some pre-tax, some Roth. I see some people doing, hey, I'll do 2% pre-tax, 2% Roth, and do a little bit of both. The next step is really determine how much income are you going to need. And one thing that I suggest to really a lot of people, especially closer to retirement, is determine what's your expenses each month. What am I paying in mortgage or rent? What's my car payment? What are my grocery payments? And you'll wind up getting a pretty close average. Maybe that's $5,000, $6,000 a month, knowing that every month, or every year or so you'll have 1 month where, the hot water heater goes or something, but you'll get an average for what you need monthly. And then look at, what income are you going to have coming in? And again, that's going to tell you if there's any kind of discrepancy or shortfall. A lot of people think or target 70 to 80% of their final income as an estimate, but I, kind of would say I would think maybe even higher than that, maybe even 100%, because it's almost like you're on a constant vacation and you're typically going to spend more money on vacation or when you're off on the weekends than you do when you're working. And that's just shown here. If your pension and Social Security is going to be 75% of your retirement income, and you're looking at 80, 90, 100%, what's going to make up that 15%, 25% shortfall? And again, that's the income gap that we're talking about. So how do you close that income gap? And there's some tips here on how you can do that. I suggest to people, even when they're starting out and they're starting out, very small into the deferred comp, they're doing 1 or 2%. I tell them every time you get a raise, if it's a 3, 4, 5% raise, every time you get a raise, at least bump up your contribution to the deferred comp by 1%. If you get a 3% raise and you allocate 1% to the deferred comp, you're still taking home more money than you were prior to the raise. When your lifestyle changes, when the kids move out, and there's, less money needed to support them, turn those dollars into additional contributions. And anytime you get to reduce debt, whether it's, getting rid of your mortgage, getting rid of a car payment, paying off a credit card, try to take that amount that you were paying towards debt and make that an additional contribution to the plan. So where you choose to invest the money is going to have a big effect on how much money you're going to have at retirement. But more important is how much you contribute. If you start contributing 5, 10% a year going for 20 years, that's going to make the biggest difference in your account balance. So we do have a tool on our website. It's called the My Retirement Income Planning, or My Income Retirement Planning. We call it MERP. And it allows you to kind of get what that estimate is. Am I going to have a comfortable retirement? It'll show it in a percentage. We've added 2 new features to the Retirement Income Planner. One will give you an estimate of your pension, and the other will give you an estimate of your Social Security. We have made it within the last 2 years, a lot more detailed. So you really have to put in a lot of information in the plan to get like a real close, accurate of, where you stand as far as retirement. Some resources that you have, you can call the state, call Albany, and they will give you an idea of what your state pension is going to be. This is, especially important when you get closer to retirement. One thing that I tell everybody they should do is to create an account on SSA.gov, Social Security Administration. It'll show you a history of your contributions or your wages from when you first started working, and it'll give you a couple of things. It'll give you your estimated Social Security at full retirement. For most people, their full retirement age is going to be age 67. You could actually take Social Security as young as age 62, but you won't get 100% of your full benefit. And if you delay Social Security, if your Social Security retirement age is 67 and you wait till 70, let's say you don't need the money right away, let's say you're continuing to work, your Social Security benefit is actually going to increase. So go on that, take a look at what it looks like for you. It's a really good exercise, really good piece of the formula, piece of the pie to determine your retirement income. So let's go back to the deferred comp. What are the limits? How much can I contribute each year? The traditional limit is $24,500. I know that's a big amount, but a lot of people do want to max out on their plan. Most people are doing a percentage, 3%, 5%, 10%. But you get capped out at this 24,500. If you're above the age 50, the government allows you to do an additional $8,000 into the plan, bringing you to $32,500. I'm not sure why it says that 7,500. And if you are between the ages of 60 and 63, it's an additional 11,000 into the plan, bringing you to 35,750. With the deferred comp, if you are above age 50 and you want to take advantage of that, we have a simple form. It's just something you have to sign and get back to us that lets us know that you want to contribute above the 24.5. So what are some of the risks in retirement that you need to think about? One is life expectancy. A lot of people's biggest concern is that they are going to outlive their retirement income. So, if my mom was 97, my dad was 95, hopefully I got those genes, hopefully I'm living into my 90s, and, you have to take that into effect. It's not, like 30, 40 years ago where people, their life expectancy was early 80s. So you want to make sure you don't outlive your money. Another retirement risk is inflation. What's the cost of goods and services going to be, 10, 20 years from now when you're in retirement? Healthcare costs is one of the biggest expenses in retirement. And more people are taking care of their adult parents or adult children, kids moving back into the house, or, mom and dad, maybe one's passed away and you're taking care of the other one. And now that's an expense for you that you may have to consider. So again, going to life expectancy, on average, men live to age 84. Women live longer than that. Their expectancy is 87. Again, depending upon, your genes, what, your with family, you see a lot of people in their 90s, and you gotta, prepare for those extra years of expenses that you're going to have. Inflation risks, as you see the cost of what different things cost from 1980 to 2025, the cost of a stamp, the cost of a gallon of milk, movie tickets, it's not just the movie tickets. You go to a movie now and it's probably costing you 70 bucks when you get the popcorn and everything else. And price of gasoline. I just filled up the car yesterday, and I think mine was close to $4. So I live in New Jersey. That's kind of depending upon where you live, and different pockets have different costs. But again, all those expenses are going up. This is an interesting slide. I look at this and I see the different retirement income, your pension, your Social Security, and even those have a lot of times they'll have an inflation factor with them, and they go up, but they're not going up as much as your is as much as your expenses. If you look at now versus 20 years from now, from your retirement income, maybe it's going up a little over 50%. But if you look at what your expenses are with inflation, that's going up over 100%. So again, those are things where you have to take into account when you're planning for retirement. So some of the questions that we get with deferred comp, when can I start pulling money out of the plan? So deferred comp is different than a 401k plan and other types of retirement plans. As soon as you separate from service, as soon as you are no longer employed, you could start pulling money out of the plan without penalty on the pre-tax dollars. At some point, the government requires you to start pulling money out of the plan. That's called a required minimum distribution. That has to start at age 73. It's a real small amount that the government requires you to pull out. Maybe it's 3 or 4% of your account. Just again, to do easy math, if you had $1 million in your account and you're 73, maybe you have to pull out 40,000 of that million that year to meet your required minimum. And we tell you what that is. Another question, hey, Pete, how can I pull money out of the plan once I do retire? You could pull a full lump sum out, roll it over to an IRA or to another retirement plan. A lot of people take partial distributions. Hey, I'm getting the bathroom redone. I need $50,000, and they'll call us and we'll send them a check for 50. But a lot of people will do systematic payments. They'll do that exercise where they'll look at what their monthly expenses are. They'll look at what their pension and maybe Social Security is, and they'll say, "Hey, deferred comp, my expenses are 6,000. My retirement income is 5. Put $1,000 a month into my checking account so I have enough to cover my expenses every month." And you could do that for a fixed dollar amount or for a term. A lot of people will do that until they start getting Social Security, and now they're getting another $3,000, $4,000 a month in Social Security, and they'll tell us, "Hey, you know what? I don't need that $1,000 a month anymore," and they could shut it off. So everything within our plan, how much you can contribute, how much you want to pull out, where you want to invest the money, who your beneficiary is, all those things are flexible and can be changed at any time. Roth has a little bit of a different rule. The money has to be in there for at least 5 years or on or after the age of 59 and a half. Except some exceptions, upon disability, you could pull it out, or upon a participant's death, that money, the Roth money, can be distributed. Here's a huge, huge benefit for people who reside in New York State. The first 20 oh, I'm sorry, I'm ahead of myself. So when money is pulled out of the plan, when you pull money out of the plan on a pre-tax basis, that money is now going to be taxable. And so we do a 20% withholding. So if you say, "Hey, deferred comp, send me a check for $10,000, or I want to take a $10,000 distribution," we'll hold 20% or $2,000, and we'll send you a check for 8,000. If you're taking periodic payments, you're doing it on a regular basis, let's say for more than 10 years, you could lower your withholdings down to 10%. Again, you'll have to make up whatever difference you have to pay when you do your taxes. But if you wanted to have less withholdings taken out, we could do that if you're doing it on a periodic basis. Again, this was the slide that I thought I was on. If you're pulling money out of a deferred comp plan and you live in New York, you reside in New York, the first $20,000 is not subject to state income tax. That's a huge benefit. Whatever New York State is, 7, 8%, you could save that if you can keep those distributions under, 20 grand. So under, $2,000, maybe $16,000 a month, $1,600 a month, that type of thing, would keep you under that $20,000 threshold and not have you subject to state income taxes. The good thing here is if you needed more, if you're pulling out 25, it's only the $5,000, the amount above that $20,000 threshold, that's going to be state income taxed. A lot of people are not aware that they can keep the money with us after retirement. And we see a lot of people that do that. I talk to a lot of people who've been retired for 5 or 10 years, consult with them. So you can keep the money here. A lot of people do that and actually roll money into this program because it's easy to have all your assets in one place. As I mentioned earlier, this is one of the largest retirement plans in the country. We have 300,000 participants. We have about $45 billion in the plan. So this is a very, very inexpensive plan. When we go to the investment companies, we get super low fees on the funds that are in the program, convenient access to your money. And if you go to, the website, there's, regular seminars on a monthly basis, similar to what Talon's doing here. You can go in there and see or participate in a webinar on Social Security, on what's happening in the market, on the state retirement plan, things like that. So you're getting unbiased educational services. And as I mentioned earlier, you can roll other dollars here. Hey, Pete, I was working for a company that had a 401k. I still have a balance over there. Can I roll that money over here? Yeah, you can do that, or 403b money, even contributory IRA money. We would just give you a rollover form, contact the previous provider, and you could roll that into your retirement account with New York State Deferred Comp. So finishing up, just a couple of things, as the previous speaker spoke about, review your beneficiary designations. That's important. Maybe you set up your beneficiary and you weren't married and you're married now, or, you got divorced or whatever it is. Make sure your beneficiary designations are current. Review your asset allocation. A lot of people will start out and say, you know what, hey, do it for me. I'm not really, privy or an expert on investments. And then they, are constantly looking at the options and what other people are doing and maybe want to reallocate, or maybe they're getting closer to retirement and want to, take some chips off the table and become a little bit more conservative. And I think that that MERP tool, the My Income Retirement Planning that's on the website, is a real good way to figure out, are you close to or ready to retire? Will you be comfortable in your retirement years? We do have an app. It's real simple. If you go to the App Store and it's My Retirement, you'll see My Retirement. You'll see that slanted M. Click on that, and everything you can do on the website, you can do on the app. It's very intuitive, real simple to use. You could change your contribution, you can change your investment, you can change your beneficiary. All of that, all simply done on the app. And you always have our back office. You can either log on to the website for information, call our help desk, which is that 800-422-8463. Someone will be there to answer your questions, make a change for you if you don't want to do it online. That's available. And here's my information. AE Connect is our account executives that are online. It's someone who's not in the field, but on the phone that can help you with anything. And I'm going to give you my cell number if you just want to call me directly. If someone could put this in the chat, It's 917-861-7235. I mean, part of what I do is I just consult people on their specific situations. Everybody's financial situation is different. Happy to sit down, pull up your account, go through whatever, questions that you might have. And again, my cell's 917-861-7235. You can go online and really just book an appointment with me. You can view my calendar, pick a date and a time that works for you, and we'll set up a Teams meeting very similar to what we're doing here. So, Talon, with that, I am going to
Thank you, Peter.
turn it back to you.
Okay, thank you. Thank you so much for your time and insights. I know that you said you could possibly stay on a few minutes and answer some of the questions.
Sure.
Some of them I answered, some of them I'm not equipped to answer. So I will defer to you.
Go ahead.
All right, thank you. So this is the time where we allow the breakout session with TRS participants. So let's see if I could do this better than I did the other day.
You got this, Talon.
Select a room. I'm going to let everyone join TRS just because I can't go through the whole list, but I think that I allowed everyone. I gave everyone access. So, but only if you're TRS, do you see the option to go there? People are dropping off. That means they figured it out. Okay, great. Oh no, everybody went there. Anyway, I think they went there by mistake. Just bear with me just 1 second.
No, que me voy a salir, por favor.
Okay. All right, so okay, they're coming back. All right, so where is Diane? You're
Okay.
here. Okay, Diane.
Hi.
So,
Okay, I was stuck in the other room. Sorry.
okay. All right, so okay, Diane, I think that everyone came back who should come back, and you can go ahead and share your screen and proceed.
Okay, so just give me 1 minute to see. Do you show my screen yet?
Yes, we can see your screen.
Oh, perfect. Okay, that worked easier this time. Okay, so what a full morning we've had. So many good discussions. Once again, my name is Diane Palembo. I'm a financial consultant here at TIAA. And today we're going to talk about how to get the most of your retirement income. This is such a great topic. Today we're going to walk through a few key ways to think about getting the most bang for your buck so it lasts longer. As you know, all your life you're told save, save, save. While that's great advice while you're working, when it comes to retiring, the question won't be, how much did you save? It'll be, will you have enough income to cover you for life? And that's what we're going to talk about today. But before we jump in, if you have any questions, you can put them in the chat box and I'll answer them at the end. And also at the end, I'll have QR codes that you can scan if you would like to schedule a one-on-one with a financial consultant. So let's get started. So today, the agenda is going to be understanding your income, creating an income strategy, optimizing your income, and let's prepare. So the answer to that question, will you have enough income to cover you for life? What you do is you need to understand the different types of income and how they contribute to your retirement. Once you know that, we'll be able to create an income strategy to manage your retirement risks and support you for life. So today we're going to look at ways to optimize your type of income or your income, like I said, to get the most bang for your buck. And then I'm going to show you how to make it all happen, how to prepare for it. Okay. So the first step is understanding your income. We're going to begin by looking at the different types of income in retirement and how they all work together. Social Security is the starting point. It provides what we call guaranteed lifetime income. And what it means is once you start taking your benefits, you get monthly payments for the rest of your life. This is what you've been paying in your paychecks your whole life for. So this is, you're going to get your monthly payments for the rest of your life. But Social Security only covers about 40% of your income needs. Now I'm going to show you something. So for instance, suppose your average salary, your career was about 55,000. Social Security only would cover about 38%, 21,000. And then the more money you make, if you made just say 137,000, it would only cover 25%, which is 34,000. So the key is also to have options, plan A along with plan B. But I suggest you visit, it's very important, ssa.gov to get your estimate. It's a very intuitive website. So if you get it, go on it and you'll be able to say, I want to retire at age 65. How much will I get? And it'll have drop downs. Okay. Pensions. Pensions are retirement plans from your employer. And it also gives you guaranteed income. But unfortunately, you know, they were really popular in the mid-'80s, but in recent years, only about 70% of retirement plans were employer-based. And in many cases, they've been replaced by the 401k, 403b, 457, which many of you have today. Okay, of course, you may still have some pension plans and everything, but you know, the majority of people now have to have their own retirement accounts in addition. So your retirement plan investments, they make up the rest. So what I've said is that for most people, your own retirement plan may be covering the majority of what you need in retirement, but you also have other retirement income, whether it's been a job, a small business, alimony, rental income. But most people do rely on their savings. And retirement plans like the 401k, 403b are very flexible, meaning any money that you put into them is yours. You can take the money out if you leave your job, and you control how the money is being invested. So your employer may contribute a portion as well, but there's also a lot of opportunity for growth in your savings because it's tied to the market. So if you start saving early, which is always key, you have the benefit of compounding interest, which really multiplies your savings. The flip side is that there's also risk. Since there's risk, your savings that's in the financial markets, it could be nerve-wracking because, you know, when the markets drop, they go up. So in retirement, as you know, there are no guarantees that your savings will last a lifetime, especially since you don't know how long you're going to live, but we have other ways, and we're going to discuss that. Okay, so we're going to discuss two things, fixed annuities and variable annuities. So right now, fixed annuity, it could help close the gap. So basically what a fixed annuity is, it's a guaranteed lifetime income. So it's a savings option that doesn't go up and down in value. It's not tied to the market's ups and downs. It has guaranteed rate of growth while you're saving. And like I said, this is your steady Eddie, so to speak. So having extra sources of guaranteed income in your financial mix may give you peace of mind. It will. Of course, I'm sure you've heard of annuities. They're not new. They've been around for a long time. Sometimes they got a bad rap, but now, I'm not sure if you know about TIAA, but they've been here for over 100 years, and many people have been with our annuities. But since 2019, Congress passed legislation that made it easier for employers to offer annuities as part of their retirement plan. And I'm sure that many of you have it in your accounts. So now, while many TIAA customers have seen benefits of lifetime income for a long time, more and more professionals are encouraging people to include annuities as part of their income strategy mix. So just to sum up, a fixed annuity doesn't go down. It's guaranteed to grow no matter if the market goes up or down, and it could set you up for retirement, checks for life, if you decide to annuitize. Okay, so the second, let me just go a little, okay. So how do fixed annuities work? Okay, a fixed annuity is available in your retirement plan. Consider putting some of your contributions in the annuity as well as other investments. If your retirement plan doesn't offer a fixed annuity, you can go and buy one at a bank, insurance company, but you also might be able to get fixed annuities through individual retirement accounts. So as I said, fixed annuity, guaranteed growth. It's the steady Eddie, guaranteed steady growth no matter if the market goes up or if it goes down.
Good morning.
Guaranteed
Another one,
income for life.
Retirement thing.
Receive,
They had three
so it's
different switches.
guaranteed. It's guaranteed income for life, meaning you receive monthly paychecks for life when you convert some or a part of your annuity savings. So fixed annuity, you contribute, guaranteed growth, guaranteed income for life. Okay, so here's an example. They're twin sisters, Tara and Rachel. They both retire at age 65. They both have $100,000. Tara takes her $100,000 in her savings and converts it to guaranteed lifetime through a fixed annuity, whereas Rachel decides, I'm going to keep my $100,000 and I'm just going to take out regular amounts of money. Okay. So Rachel has recurring withdrawals of $7,600 and the same as Tara. So they're both getting the same amount, right? So then what happens is Rachel, since she wants the same amount of income, but she doesn't want to annuitize, her withdrawal rate is 7.6%. If the interest rate is 5.15, it means that she is taking out more than she's earning. So basically at this rate, Rachel's account, when she's 87, will run out, while Tara will be able to keep getting her $633 a month until she dies. So this is just an example, and it's the numbers are hypothetical, it's not guaranteed, and it illustrates the strength of TIA fixed annuity. Okay.
She's driving. Nicole. She's in Brooklyn.
So we're going to talk about how variable annuities work. So variable annuities, it's market growth opportunity and retirement income for life. So fixed annuity, guaranteed growth. Now there's a variable annuity. So you can contribute the same, the way you do in your fixed, you can contribute in your variable. And it also provides monthly income for the rest of your life. But the difference is it takes advantage of the growth opportunities. Think of it as tied to the market. So when the market goes up, your variable goes up. When your market goes down, variable goes down. But over the course of time, from the S&P, you will be ahead of the game, not guaranteed, but this is where you're going to have the growth in the variable. So it's based on of underlying investments, stocks. Okay, so when you retire, the monthly amount you receive is not fixed. It's also variable, and it'll, as I said, rise and fall depending on the underlying investments. You'll still receive monthly income for life, but it could vary. So choosing the variable is not an either or decision. It's a great strategy to pair together with the fixed annuity, which is rock solid, and then the variable, which, you know, helps offset inflation. So how do we do that? Step 2, we're going to discuss creating an income strategy. We'll look at how these two come together in an income strategy for your retirement. Okay, so we have to be aware of retirement risks. It's always important to understand that there are always unique risks in retirement that you need to prepare for. You may need a combination of the different income sources to address this. So in other words, the same way that you may want to have a diversified mix of investments for your retirement savings to help manage your risks of investing, you may also want to have a diversified mix of income in retirement. So we just have to look at what those risks are. So first is longevity. 51%, there's a 51% chance that one partner will live. Well, let me just say this again. So among 67-year-old couples, the likelihood that at least one partner will live till 90 years old is 51%. More and more people are living to age 100. So that means that income needs to last you so you don't outlive your savings. So lifetime sources of income to help with this. And then there's market volatility. Investing involves risk. While overall, the market historically has continued to go up, the timing of the inevitable drops can make a difference, especially if you're early in your retirement. So there's 1 in 4 risk of a chance of a loss in any given year. Guaranteed sources of income can help offset that. As I said, the fixed annuity. Inflation, of course, is another risk. As prices go up, the buying power of your income, which is often steady, goes down. So in the last 20 years, inflation has varied from a negative 0.4% to 8%. It's a big range. And in the 1970s, inflation was even higher, peaking more at 13% in 1980. So the risk of having income that provides opportunity for growth can help ensure that you'll have enough money. That's the bottom line. You'll have enough money when the prices go up. And finally, cognitive decline. No one wants to think about cognitive decline, and it's a risk because it does threaten your ability to manage your own finances. And it could begin as early as you may think, as you may not think. In fact, 10 to 20% of people age 65 are mildly impaired. Income provides automatic payments for life to help address these issues. Now you're going to ask, are your risks covered? All right, so let's see what this means for your income plan. If we look again at the likely sources of income for most people, it's going to be Social Security at 40% on average, and your retirement plan investments, which generally make up the rest of your income. So Social Security, as I said, it's guaranteed money. You get monthly income checks for life, and it does a good job of addressing all the retirement risks, as we talked about. It lasts as long as you live. The amount will go down even if markets drop, and it includes some adjustments for inflation, a little bit. It pays you automatically, so you don't have to manage anything if you experience any cognitive decline. But as I said, it's often less than what you actually need in retirement. Now, on the other side, your retirement investments, they provide important growth opportunities to fight inflation risk. They don't address longevity risk, the market risk, or the risk of cognitive decline, since you have to manage your money yourself. Okay, so consider adding more income that lasts for life. So to help diversify your income to more fully address retirement risks, one option is to add the stabilizing features of fixed and variable annuities. This switches the foundation of your retirement income from being passed primarily on sources that may not last a lifetime to sources that do last a lifetime. And then this helps ensure that you have enough money to cover essential everyday expenses, and with money that you can count on. And so that could be a big difference when you're talking about living in your 90s to even 100, as some of you may. So if you can or already have been saving in annuities during your working years, you can convert some of them or all of them to lifetime income when you retire. But if you're close to retirement and you don't have annuities in your mix yet, or perhaps not enough, you can always purchase them. Purchase annuity with some of your regular savings. And the amount of retirement savings, as a rule of thumb, just so you have like some basic, is about 2/3 of your total retirement income from lifetime sources. So remember, this is just an example. You should also do what makes sense in your situation. Be sure to understand all the ins and outs of annuities before making any moves with your money, because it's important to note, once you convert your money to lifetime income, you won't be able to change your mind. So at TIAA, we do offer something, and it's called Income Test Drive. It's only for our variable annuities. So what you can do, it's pretty cool. You could try out your lifetime income for up to 2 years to see, you know what, this is what I want to do before you make your final decision. And if you have a TIAA account, you could schedule a call with a financial consultant at any time to find out more about the annuities and how they work, and just to see if they align with your goals. So, a variety of income sources help reduce risk. So here you're going to see how diversifying your income can help check all the boxes when it comes to addressing retirement risks and creating a more secure retirement. So as I said before, it's really no different than the way you diversify your investments to help reduce the risk. When you're saving, here you've helped to reduce the risk by diversifying your retirement income. So beyond your Social Security, your retirement investments can give you growth to cover extra cost and wants beyond the essentials to address the inflation risk. Your investments also offer ready access to savings to address any unknown risks that are part of life, like perhaps some medical or just other basic expenses. Annuities also help cover the risks of longevity and cognitive decline because the income is automatic and lasts for the rest of your life. A fixed annuity addresses market volatility with steady income, while a variable annuity offers growth opportunity to fight inflation. Now, as I said, we're not suggesting that you turn your entire savings into lifetime income, but it's all about diversification and strategy to address all of your needs. So the step 3, optimizing your income. Now we've looked about how you can build a diversified income strategy. Now we're going to talk about how to get the most from every part of your income. Okay, so the timing of Social Security matters. So the earliest you claim Social Security is 62 years old, but the benefits are reduced by 30% when compared if you receive it at the full retirement age. So, for instance, your benefits are full at 66 or 67. It depends on when you were born. So if you were born between 1943 and 1959, your full retirement age is sometime during your 66th birthday. But for those that are born 1960 or after, the full retirement age is 67. So every year that you delay taking your Social Security, from there up to age 70, your money goes up, okay? So the difference between starting at 62 with reduced benefits and waiting until 70 with increased benefits can be as much as 77%. So it's worth considering if you want. This is an entirely, it's a personal decision. So your Social Security benefits, they're based on your highest 35 earning years. So $2,000 a month. You would only get $1,400 if you said, you know what, I'm going to turn on my Social Security at 62. But you would get $2,480 if you said, you know what, I'm going to wait till I'm in my full retirement age. So if you're a public employee, it's also important to note Alaska, Colorado, Louisiana, Maine, Massachusetts, Nevada, and Ohio, there's different rules regarding Social Security disability benefits. Okay. So when it comes to withdrawing your retirement accounts, it's common to follow the 4% rule. As I mentioned earlier, it simply means that you withdraw. If you withdraw more than 4% from your investments each year in retirement to preserve your balance for many years, if you want to keep up with the pace of inflation, you can adjust the withdrawals. Meaning you could either have a flat setting or like a flat increase based on what the actual inflation rates are. So for instance, when markets go up, a withdrawal of 4% could be more than you need in a year. So consider taking only what you need each year to offset the years when markets do go down. Also, with any pre-tax accounts you may have, the IRS requires you to start taking the required minimum distributions, RMDs, when you turn 73. And you have to pay taxes on that money then. And you don't want to miss those deadlines because there's a 25% penalty on your RMD if you don't take it in time. So consider the 4% rule. So annuities can cover your beneficiaries as well. So how can you optimize income with annuities? Some annuities, like the ones we have here at TIAA, give you the flexibility to continue monthly income to beneficiaries if you pass away. See, that's something that people don't know. It's a common myth that with annuities, when you pass away, you lose the rest of your money. But that's not always the case with annuities like ours. You have several options. You can set them up just for yourself, which offers the highest payout rate because it's only covering you. You can set them up to cover you and your spouse or partner if you prefer, so the payments can continue throughout both of your lives. Or you can set them up to cover your children or other beneficiaries. They will receive payments for the rest of the guaranteed period. It's usually 10, 15, or 20 years. It keeps monthly income going to them for a specific guaranteed period that you choose. And it's a good way to ensure that your money you put will continue to benefit someone else. So having annuities also helps optimize your income in retirement by allowing you to delay Social Security if you choose to do that. In other words, if you have enough regular income to cover your expenses through your annuities, you could possibly wait to take your Social Security, giving you more money, higher monthly income. So what do? We prepare now. Now that you've seen how income works in retirement, I hope you'll take the next step in preparation. And here's what I suggest you do. You talk to a professional, and I'll get to that page in a minute. But what we can do is we could save money, create a spending plan, and review the investments. So it starts with making sure your current savings and investments are on track for your goals. Take a look at how much you're saving. If needed, try to increase it. And remember that starting at age 50, if you're already saving the minimum in your retirement, you can add catch-up contributions to save even more money. And if you have a TIAA account and want to see your savings to make sure that they're on track, you could log in and use our online tool at TIAA.org/advice now. And it shows where you are today and what you can do to help achieve your goal. So to help save yourself money and keep expenses in check, it's good to have a spending plan, a budget. And it allows you to see where you could free up money, where your money's going. Having a spending plan worksheet is key, and you can download it from our resource list in the webinar at TIAA.org/budget. If you want to start estimating your retirement expenses and income to help you create a retirement income plan. It's also important to check on your investments. Make sure your investment mix is properly diversified and still in line with your current age and goals. This helps manage your risks while taking advantage of the growth opportunities. And the online tool that I also mentioned is TIAA.org/advice now. You could go in and play around with the different numbers and, say, I want to retire at 67. What do I have to do? This is the amount of money that I have and I would like to have each month. So it really gives you like a model so you know what you're getting and know what to expect. So there's no substitute for talking to a professional about your personal goals. If you have a TIAA account, you can call one of these numbers or schedule a one-on-one. You can scan that QR code. TIAA consultants can talk you through all of your income options and help you plan your retirement, and there's no cost to you. So call us 800-388-6424. And if you're retiring in more than 12 months, it's 800-842-2252. Now, once again, here are the other QR codes, one to learn and one that'll bring you to the webinars. And thanks so much for joining today. And I hope it's been helpful as you think about your plan, your income in retirement. And please feel free to email any questions or put them in the chat box. And if you want more information on this, I would suggest scheduling a one-on-one with a financial consultant. That's all I have for today.
Thank you so much,
Does anyone-
Diane.
Does anyone have any questions?
There's a question about, do I have to take RMD if I'm still working at 73?
Yes. Yes. You have to take it at 73. The government wants their money, and it's a mandatory age that you have to.
Okay. Jean Geiger, you've had your hand up for quite some time. Do you want to unmute yourself and ask a question?
No, somehow I clicked that and
Okay.
sorry,
It's
I was trying
okay.
to click
Wait.
something else.
That's okay.
Also, I just want to say that it's a mandatory withdrawal. And basically failing to take them will result in a tax penalty, I believe 25%. So it's something to plan well in advance for.
Thank you. Wilson, do you want to unmute yourself and ask your question?
Yes. Is the RMD age going to increase to 75? I've been reading certain articles saying that it'll increase to 75. But
Well,
that's not my question. But that's one
Okay.
question. I got another.
Okay. What's your other?
So I've spoke to a TIA representative, but he wasn't really part of the TIA CUNY, specifically for CUNY. Should I continue with him, or should I schedule an appointment with someone like you that's TIA-CUNY, that's more CUNY orientated?
You can schedule an appointment, scan the QR code and schedule an appointment, and I just think that it'll route you to someone that's covering CUNY, but I have to double check that. But when you do your schedule now and you speak to someone, I'm not quite sure if it will automatically direct you to CUNY, but I think that you could request that.
Okay. I mean, the guy was good. The person was really good. And I hate to, I hate to switch. I like to be loyal.
Oh, no, that's good. But also, Talon, I don't know if I know that there's a team dedicated to CUNY. So if you like the person that you're talking with, you could ask them, because they could pull up the CUNY plan rules right then and there. So it's not as if they don't have access to that.
Understood.
You can go to you can ask your benefits officer at your campus who the TIAA rep is for your campus, and make an appointment with them, find out when they're going to be on campus. The HR offices at the campuses coordinate on-site visits. So, you can ask them if they're planning to have someone on site that you can make an appointment with.
Thank you, Talon.
Thank you.
Can you give us an idea of what the RMD percent is?
You know what? Well, I don't have like a schedule of the exact amounts. It all depends on your savings in your 401k or whatever other retirement account that you have. So that's a schedule. So I can't say, okay, if you make 100,000, this is how much you're going to pay. You have to speak to an advisor about that because it's based on your specific retirement savings in your 401k or 403b. So it's a schedule.
Okay. Sharon, you have your hand raised. Do you want to unmute yourself and ask your question? Sharon Persinger? Oh, I guess not. Okay. Oh, yes? No? Okay. The difference between 403B, how do I unmute? There's a mic icon on the top right of your screen.
I found it.
Okay, good.
So my RMD question is, I can find the tables and see what the percentages are, but I don't know how the base amount that the percentage is applied to, how that is determined. For instance, if I'm taking an annuity of $2,000 to $3,000 a month, does that amount count as part of my RMD?
Okay. So the RMD, it's an amount that the IRS requires you to take out. Basically, they want their money and they've waited till 73 years old. Okay. So once you reach that certain age, you have to start withdrawing it. Now, as far as your annuities, that's not for the RMD. It's not as if it's like they're not connected in the sense that, okay, I already got 2,000 from my annuity. Now, do I only have, I'm just throwing out a number, 87,000 left that I have to pay for, or that I have to withdraw from my RMD account? They're not like inverse relationships. So basically you have to look at your schedule. You can go to, I think ARP has one. You just go on Google your RMD schedule. You can go on TIAA or other Fidelity, other websites, and you put in your age, the amount of money, just say $1 million, and it'll give you a schedule of how much you have to withdraw each year from 73
So
on.
if
Can I
I'm
help-
understanding
can
right,
I-
then that means that the amount I have annuitized does count for that.
Can I chime in for a second and try to
Yeah.
explain? Like
Sorry, I'm
sometimes,
a math person, so I think about numbers a lot.
so can I just explain something in layman's terms about how an annuity works? So if you say that you want to annuitize, let's say $50,000, which is what we require for TIAA participants if they're eligible for retiree health. So what happens is TIAA says to you, okay, we're going to take $50,000 out of your account, and in return, we're going to give you a fixed dollar amount every month for life, guaranteed. Whatever amount that is, based on your gender, based on your life expectancy, your age at the time of annuitization. So that $50,000 that you annuitize is actually removed from your account. So you don't see that amount anymore because in return, you're going to get a monthly check. So that I think that's the way the 50,000 is not factored in to your RMD because that money's been withdrawn from your account already. They take that and in return, they give you a guaranteed monthly check for the rest of your life. Is that right, Diane?
No, you're right. That's, so I like the number. So you annuitize the 50,000, you convert it into your guaranteed amount, $2,000 a month. And then that main money comes out of the pot, so to speak, if that makes sense. And you know what? You did a great job, because does that make sense to the person, I'm sorry, who asked the question? Because it's guaranteed.
So that,
and
like,
it's-
that 50,000 has already come out of your account. If that's,
yeah, it's no
that's
longer
done.
shown.
It's
Yeah.
no longer
Yep.
showing in your account. So whatever
Yep.
RMD calculation is being done, it's done on the remainder of the cash
Yep.
that's in your account. It doesn't include
Right.
that annuitization, that annuitized amount anymore.
Yeah,
So that's
so
the annuity.
yeah.
What if I choose to take to schedule withdrawals, but I don't annuitize an amount?
Yeah, you can
Then
do
that-
systematic withdrawals. Yeah, without annuitizing. But then that, yeah. Right, Diane? Like you can
Yeah,
say,
you don't.
I want you
yeah,
to, I want TIAA to send me $2,000 a month from my account balance.
right. You don't have to annuitize to create your income. And so, yes, you can take systematic withdrawals where you choose a set amount percentage to withdraw. That'll be how much that you need to, like if you have just say 100,000 or $1 million in your retirement, and they say you have to take out 150,000 a year, you can make a schedule and say, okay, I want X amount each month, quarterly, quarterly, however you want it to be distributed. But once you decide to annuitize, just say 50,000, that 50,000 comes out of the $1 million. So it's $950,000. Does that make sense in that way?
And so then that amount would count towards the RMD for that year. I think that's the point. The RMD is a percentage that has to be withdrawn each year.
Yes. Yes.
Now it makes sense. Thank you.
Yeah. Okay. Okay. I know it is tricky. The systemic withdrawals, they can count toward your RMD, but basically the RMD IRS minimum required, that's just a schedule that you have to follow online. I wouldn't be able to have those numbers. I hope
Wilson,
that answered.
Yeah, Wilson, did you have another question? Your hand is
Yeah.
still up.
I do, but I forgot. Sorry. If I remember, this is a lot of
Okay.
information, and
I
technical
know.
too,
But it's exciting. It's
Yeah, it
exciting.
is.
You've worked your
Yes.
whole life for this. And so you decide, all right, I'm going to annuitize. I'm just going to take the money out of the account. And this is like such great stuff. And it's so
important.
dynamic.
It's very
Because you-
important because it has a lot
Yeah.
of tax implications too. So,
Yes.
but you and your
Yes.
loved ones.
Yeah, definitely. Because, you have to decide, oh, okay, when I pass on, how much is my daughter or son going to pay in taxes? How do I structure this? And that's where the other person that was talking about estate planning, he'll come into hand.
Now I remember my question.
Oh,
Thank you, Diane. This question is basically for Talene. Talene, the
Okay.
$50,000 for health, right? That you have
Right.
to, if you have, could that be 75,000 or has to be 50,000 annuitized?
No,
Could it increase?
so the
Could it
way-
be yeah.
So the requirement is that you have to annuitize a minimum of $10,000, but you have to freeze 50 total. So if
Right.
you annuitize 10, that's 40,000 left that you are not allowed to withdraw from your TIAA account.
Mm-hmm.
In order so that in the future, if premiums increase and you have to annuitize additional funds to cover whatever the premium is for the retiree health, that money has to be frozen in your account. So you annuitize a minimum of 10,000 and you have to freeze a total of 50, but you can withdraw everything else.
Yeah, but that 50 is I'm saying, could you annuitize instead of,
You
I know
can
you need 10,
annuitize, right? So if you decide that you want to annuitize $250,000 so that you
Yes.
have a steady income a guaranteed income every month, you will have satisfied that requirement.
Okay, understood. There you go. Talene, can I make an appointment with you?
We'll talk offline about that.
So
Deborah
sweet.
Deborah Parker, did you have a question?
Can we get a copy of today's presentations, the three of them?
Diane, can we?
Yes, yes,
Okay.
absolutely. Yes.
Diane will
Thank
send
you.
it to me and I will share it with everybody.
Thank you.
Okay,
Okay.
okay.
Sharon,
I will
did
definitely do
you
that.
still have your hand up? Anyway, okay. The recording of this, of today's seminar will be shared with everyone as soon as I download it and post it on our website. We have a dedicated benefits site and all the recordings will be posted there, and I will share a link with everyone in the next few days. So with that, we will conclude our pre-retirement seminar for our instructional staff for 2026. Diane, thank you so much for your time and insights.
Thank you.
And everyone have a great day. And if you have additional questions, feel free to send them to me. And we will answer as many as we can because retirement to CUNY is a complicated proposition, and you can never have too much information. So have a great day, everybody. Thank you, Diane. Bye, everybody.
Thank you. I'll send you the copy.
Okay, good.
Bye,
Thanks.
everyone.
Thank
Bye.
you all. Good job.